and welcome to the Texas Mortgage Bankers Association's Education Webinar Series brought to you by the Education and Endowment Committee, led this year by co-chairs Hannah Barton and me, Stephen Bertrand. I'll be facilitating today's webinar titled From Broker to Banker, Navigating the Transition to Correspondent Lending. Before we begin, I'd like to remind you about TMBA's biggest event of the year, the 109th Annual Convention, happening April 27th through 29th, 2025 at the Lowe's Arlington Hotel in Arlington, Texas. Registration is now open, and we'd love to see you there. Don't miss the opportunity to network, learn from industry leaders, and stay ahead in the mortgage world. Visit texasmba.org to register today. We encourage you to participate in today's session. Feel free to ask questions throughout the webinar using the Teams Q&A feature, and we'll do our best to address them during the Q&A session at the end and throughout the webinar. Now, I'm pleased to introduce our moderator, David Frase. A native of Dallas, Texas, David Frase graduated from the University of Pennsylvania's Wharton School of Business in 1986. He spent his early business years in secondary marketing, correspondent lending, and as a retail manager. In 1992, Frase moved into warehouse lending, where he has remained since. In 2000, Frase launched a new kind of warehouse program designed specifically for small mortgage originators who were traditionally ignored by larger institutions. The idea took off, and the first generation of non-Dell lenders was born. Today, Frase operates the warehouse program at Simmons Bank. He has helped hundreds of mortgage brokers successfully make the transition to mortgage lending. Frase is a member of MBA's Future Leaders Class of 2003, a graduate of the School of Mortgage Banking in 2004, and Master Certified Mortgage Banker designation in 2005. Frase has been honored with TMBA's James Wooten Scholarship, TMBA's Larry Temple Distinguished Service Award, and the MBA's Willis Bryant Award. He is highly active in the Texas Mortgage Bankers Association and served as its president in 2011. Frase is also an Eagle Scout and never plays golf. I'm also pleased to introduce our presenter, Garrett Griffin. Garrett is a seasoned leader with over 30 years experience in the mortgage banking industry. He has extensive experience in non-delegated correspondent lending and all TPO delivery channels. Garrett has a reputation for devising, developing, and improving the profitability, performance, and value of customer business while increasing market share and revenue in the process. Garrett's passion is helping successful mortgage brokers evolve to profitable, thriving mortgage bankers while mitigating credit and fulfillment risk. He strives to help optimize profitability for existing non-delegated correspondent lenders by improving delivery systems and efficiency. With that, let's dive into today's discussion. David, with your extensive experience in warehouse lending and your deep involvement in the mortgage industry, we couldn't ask for a better moderator to guide this conversation. I'll turn it over to you to get started.
Thank you, Stephen. It's really great to be here. I'm going to attempt to share my screen, warning everyone that I am a baby boomer, kind of. So I need validation. Stephen, so is the screen showing up correctly?
Looks great, yes.
Well, then, I did something right for once. Okay. This is a presentation to help people kind of dispel some of the myths about what is the process of moving from mortgage broker to mortgage banker. I think Stephen called this session navigating, so I decided to use the compass to kind of tie in cutely to his title for the event. I wanted to emphasize I brought in Garrett Griffin because when I first started this idea of broker to banker for small brokers, this is back in 2000, 2001 era. The biggest challenge I had first off was getting takeout investors to agree to buy loans from these guys who had minimal net worth. The logic of the process was if you're non-delegated underwriting, you have someone else generating the legal documents, There's very few things that are going to go wrong if you're funding the loan yourself. So why not get you a warehouse line and let you operate as a lender? Garrett was one of the first investors to really get it. And he was with Flagstar Bank back at that time. And they became our first major investor in our program and really helped us spread the concept of broker or banker around Texas and then eventually around the country. So Garrett and I were kind of there at the very beginning, and I'm very fond of him as a result of all those great years we had together, road shows, et cetera. So we're kind of getting the old band back together again to do this. I saw that I just noticed in the attendees that Dre Roberts is out there in the audience, and he was also kind of part of that initial group of signing up all these first generations of brokers. So I'm very proud to have him on this call, and I hope he keeps his mouth shut for the rest of the presentation. All right, so first of all, just going to define some things for you. What is a warehouse line of credit? Some people, it's a kind of a strange name for this type of business or what I do. But technically, a warehouse line is I'm going to read slides to you. I'm going to try not to do that. I mean, the slides are available. I assume they'll be available after the presentation for anyone who wants to see them. But basically, it's a commercial loan from a bank to a mortgage company to help the mortgage company fund their own business. When the mortgage broker draws on a warehouse line to fund a loan in his own name, he ceases to be a mortgage broker and becomes a mortgage lender. The term warehouse lending, believe it or not, it comes from an old type of inventory finance that banks have been doing for hundreds of years. Where literally the mortgage loan is your product that's going to market. So it's technically in the mortgage company's warehouse on its way to the secondary market, which is why they call it warehouse lending. It's a very silly term, but it's been around a long time. I get a lot of advertisements for forklifts and stuff in my business, and people calling me up wanting to do all kinds of weird commercial financing because of we calling it warehouse lending. But the name's stuck, and it's kind of what it is. So just before we go any further, let's just talk about just what are the steps for how warehouse funding works. There's a lot of mystery around this for people who've never done it before. So we're going to walk through each step very, very quickly and very succinctly on just who does what and when. First step, of course, if you're the mortgage company, you're going to get a line of credit approval from a warehouse bank. Usually not always a bank, just a warehouse lender. There's various kinds out there who are available to work with you. You'll get approved for the line of credit. You'll execute an agreement. It's basically a commercial loan. You'll be underwritten like your mortgage company is borrowing from the bank. When it's time to start funding loans, you will still pick your investor that you sell the loan to. The warehouse bank has nothing to do with that decision. You get to pick your own investor. The warehouse lender may want to approve the investor, but it's still your investor. You'll pick that, and it's most of the time it's going to be the same investors that you probably broker loans to now. But you'll pick out your investor, you'll submit it for underwriting, obtain a clear to close. Once you've done that, you'll engage somebody to generate your legal docs, your closing docs. There's a lot of options there on how to generate closing docs. You can either hire one of the many third-party companies, not unlike the one Stephen Bertrand works for, who will generate closing docs for you, or you can engage the investor to provide that service if they do. Not all investors provide closing docs. And in those cases, you will probably need to get a third party to help you do that. We believe very strongly in this step because it does prevent errors. If the third party who's got the experience generates these legal documents, they're going to avoid some of the tripwires on disclosure and documentation and calculations that can upend your loan. So it's best, particularly early on, to have somebody experienced generating those documents for you. I can't emphasize that enough. It's very, very important early on. Then what you'll do, once you've got somebody generating the docs and sending them to the title company, you'll engage the warehouse lender to ask us to send proceeds to the title agent. The warehouse lender will typically ask you for some documents to prove that you've got a clear to close. They want to prove you've got the loan locked in. They want to see the appraisal of the application. There's various documents that you'll provide. Most warehouse lenders will have some kind of portal that you can submit these things to and some data they're probably going to want. But once they have all of that and the wire instructions and the title agent set up in their system already, they will send the money off to the title company and your borrower will close. They'll sign the original note. And another point I want to emphasize at this point, that original note is going to have your company name on it, not your investor. None of the documents at the closing table will mention the investor because you're the lender now. All the fees on the CD are payable to you. All the disclosures, et cetera, are in your name. And it's your loan. You've made a loan here. But the title agent is going to send the executed note directly to the warehouse lender. That says our collateral. We're very freaky about that. We want to touch that piece of paper if it's a paper note. We want that note in our hands as fast as possible. There's a legal concept there called holder in due course, or that certifies our lien, gives us a lot more rights over that loan if something should, hopefully not, but if should something go wrong, us having touched the note is a big deal. The agreement you've signed with your warehouse lender will gives you a time frame to get that loan successfully sold to a take-on investor. Most of the agreements will go from anywhere to 45 to 60 days, but don't panic. It almost never takes that long to get a loan sold. Usually, particularly in the non-Dell space that we're in here, you're going to sell that loan in about 4 or 5 days, not 45 or 60. It's very, very quick, particularly if all the moving parts are set up correctly. We give you 60 days, so if there is a problem, if you need another document signed by the homeowner, something else goes wrong, we give you time to get that worked out or find another investor or something if that should happen. But it's an extremely rare occurrence in the non-Dell space for a loan to get stuck for any reason. But we do have rules and process for just in case that does. So you've told us to you've told us now to send the executed note to the takeout investor, which we will do. We usually endorse the note for you. We attach some other documents to the investor to tell them where to send the money when they buy the loan, etc. Then the takeout investor sends the funds to the warehouse bank to purchase the loan. All the money comes to the warehouse bank. So we've sent the money out and we've had the money come back to us. So we're going to have generally more than what we sent out coming back to us because you're selling this loan for a premium, et cetera. So in that case, we're going to have money left over after we get paid. And what we're going to do there is we're going to deduct the fee transaction that we're charging. We'll deduct the interest that you owe us for while the loan was on our warehouse line. And then we'll send the rest of the proceeds back to you. Usually you'll have a bank account with the bank you're working with. And when the loan sells, we just make a deposit to your bank account. And that's how you get paid. So the whole process, it's a lot of steps. There's 9 steps, but that really only takes about 5 days, 6 days to get done. All right. People come to us for warehouse lines hoping for the following things that aren't necessarily true. A lot of people have the impression that the most important reason to get a warehouse line up front is to get better pricing from their investor. That's not always the case. Sometimes it's even the opposite of that. Sometimes the pricing is not as good as what you might get brokering. It's just a fact of life. It's the wholesaler still doing almost the same amount of work that they were doing when they bought from you as a broker, maybe a little more in some other cases. The account executives are typically paid the same way a mortgage broker account executive is paid. So you generally do not see better price execution versus broker. Sometimes you can, and in certain product types, like in government loans, you may actually see some better pricing. But generally, I tell people up front, don't expect a huge pickup in fee in price when you do this. The warehouse line does not give you the ability to rush your documents to closing before you got your final clear to close. Most investors, most third-party fulfillment companies, the warehouse bank's opinion, you don't send docs to closing until the loan's approved. That is just a recipe for disaster. People bring this stuff in-house to hope to do that, usually end up stepping on their own rake. It's a very bad business practice to get docs out. I know your realtor wants them fast. It looks like you're really on charge of things, but if you don't have that final approval when things can change at the last minute, you really don't want to send docs out until the loan is fully cooked and ready to go. A warehouse line is not typically an opportunity for bridge loans or other types of financing like hard money, et cetera, et cetera. The banks will typically have very strict rules on what kind of loans you can put in the facility. Sometimes you can negotiate what's called a sublimit from a warehouse line, saying, "Hey, I'd like to use 10% of my warehouse line for manufactured housing or for second liens or even non-QM." That just depends on how sophisticated your arrangement is with your warehouse bank as to whether they'll start letting you drift into those other areas. Up front, when you're new, don't expect that. Expect this is going to be agency paper only, and it's going to be, very, very controlled as to what you can put on that line. I've heard account executives out there say, "Don't worry about a warehouse line. It's risk-free. Nothing can go wrong," and that's absolutely not true. There is risk to you getting a warehouse line. There's more risk to you having a warehouse line than brokering a loan. Things to keep in mind when you switch from broker to lender. The agreement with your investor may change. I'm going to ask Garrett to talk about that a little bit too. You don't necessarily have the repurchase liability that you might have if you were underwriting your own loan, but the agreements are a little bit tougher. And there are things that can go wrong for you, and there's things that can cost you money if they do go wrong. I will emphasize again that in this structured environment that I'm talking about, it's incredibly rare for the originator to take a risk, to take a loss. It's extremely rare. And I'm talking, maybe 1 or 2 units out of 100,000. We might see something go wrong like that, but it can go wrong. And legally, it's important, believe it or not, from the regulator side, it's very important that things can go wrong. That's how you prove you're a lender and not a broker. And sometimes with certain regulators, it's important to be able to make that statement. So why would a warehouse line do this line of business? What's in it for the bank? Why do we want to do this kind of business? Typically, warehouse lenders classify this kind of lending as what's called a commercial industrial loan or a CNI loan. These are difficult loans typically for banks to make in any kind of volume. It's different from a real estate loan. It's considered a CNI, commercial industrial. Those are not as many loan opportunities in the banking world for that kind of lending. Usually banks have a lot of availability with their liquidity and their capital to make these kinds of loans. So they do like warehousing because they can get a lot of money deployed relatively quickly in this particular loan classification. The other things that like the warehouse lender, every warehouse lender I've ever heard of has some kind of transaction fee. So it's a fee income opportunity, which is also very difficult for banks to access. You get a big commercial loan from a bank, you may or may not pay an origination fee on a traditional commercial loan, but transactionally, you're generally not going to have to pay much in fees. With a warehouse line, you'll pay a fee with every loan you fund, and the bank can dial that in, and he can anticipate what his income's going to be when he makes a line of credit out, and it's a very important angle for a bank. We like that the collateral. I might make a $10 million loan to your mortgage company, but my collateral is spread out around dozens and dozens of different homeowners with different credit characteristics. So in a way, our risk is diversified. Even if we do a $50 million line to somebody, that's hundreds of loans that risk is spread out. We got hundreds of people making payments on that loan ultimately. And for us, that's lower risk, and we like that aspect of it. If you're working with a bank financial institution, you're also going to find they're going to be very interested in having you bank with them. Mortgage companies tend to handle a lot of money. You handle escrow deposits. You have a lot of income. You make a lot per transaction, and having that money hang out at your bank rather than at some other bank does improve your relationship with your warehouse lender. Some warehouse lenders are in this business because they also have a correspondent lending division they want to support. I'm seeing less and less of that these days, but that used to be quite common. That if the company had a pretty sophisticated correspondent lending division, they'd offer a warehouse line as kind of to augment that relationship and to get additional business for their correspondent channel. So Garrett, I'm going to call on you if your voice is up and running, and talk to me about how the takeout investor views brokers versus lenders in their channel.
Well, we love mortgage brokers. I don't want to say that we think correspondent lenders are better by any stretch of the imagination, but what I found historically is that a correspondent lender typically works with about 3 to 5 investors. So not only are they going to be considered more loyal customer, but they're going to give more of their business to those investors. And so from an investor standpoint, if you're looking at that relationship and someone's coming to you for an exception or a favor, and you're getting 25% of their business, you're going to do everything you can to make that happen. Not to say that we wouldn't under every circumstance. Again, it's the same subject as number 2, concentrated deliveries. We just get more business by each individual non-delegated correspondent. If we're fortunate, we're getting a 13 to 20% market share, which is pretty darn good. In the broker world, it's not uncommon to see 3-5%, unless it's a different investor. One of the things that I like, and you and I've talked about this and joked about it, is I'll get phone calls all the time. What's your minimum net worth? We quote one. But really, it's what are you able to get a warehouse line? Because the due diligence that the warehouse lender is going to perform is significantly more sophisticated than we're going to do as a normal takeout investor. I mean, PRMG does a fantastic job looking at the package of an emerging broker to banker. But the warehouse line is taking a deeper look because they're concerned with the personal liquidity of the borrower to make sure that they're going to be able to not break the covenants of the relationships, right? As you said, there's fewer moving parts. One of the things that I think is most tremendous is a non-delegated correspondent is allowed to use the AMC of their choice and be the customer of that AMC directly, as opposed to when you're a mortgage broker, of course, you're doing a round robin of a round robin. So they're going to have 3 or 4 different AMCs. That's going to be rotated, and then, of course, the appraisers are rotated. I still don't advocate it's a great idea for loan officers to have direct communication with their appraisal partners, but being able to at least say you have one AMC that's national, with a national presence that you've got a sophisticated relationship with, you are going to be able to get service enhancements and generally better treatment. You know, there are fewer moving parts and complaints. Most of our we're a little unique. Every single new non-delegated correspondent goes through an orientation with us, and our senior officers on that call, our head of fundings on that call, our head of setups on that call. So we try to bring the head of everybody together to have a communication about what parts of this best fit you, and can we alter those without getting too far off the track to customize the solution that makes sense for you as a new emerging correspondent lender. And finally, you know, we are embracing risk management and doing the very best that we can for due diligence to protect the, I say it this way, to protect the broker or emerging mortgage banker from themselves. So when you put all those, when you put all those together, it's become a fantastic opportunity. And you know, thank goodness for 20, golly, it's longer than that. When you and I got the opportunity to get this thing going, it's still fun. You know, I still get jazzed when I get a call from that good mortgage broker. He says, "Hey, you know, I've been hearing about this. Tell me about it. Does it make sense for me?" So, you know, I fully embrace it, and I hope you guys do too.
Well done. Thank you, Garrett. So why does the originator want to do this? What's in it for us if we're going to go get a warehouse line? Um, like I said, I told you things that it wasn't. I said it was not necessarily improved pricing. This is actually answering this slide's always been kind of a mystery for me over the years that I've offered this. And actually, at one point, a few years ago, we had a roundtable of some of our new converts to get together at lunch and just to talk through what was your experience, what was hard, what was easy, why do you do it, why do you still do it? Because I've noticed over these years of doing this that once somebody gets a warehouse line and uses it significantly for their business, it's extremely rare for them to go back to brokering. They continue to stay. They continue to stay with the warehouse line. So I say, well, why are you doing this? Because it's better. Well, why is it better? Well, it's better. So are you making more money? No, I don't think I'm making more money. Okay. Well, is it, you know, less time for you? No, it's probably a little more time. So why are you doing it? It's better. I mean, the conversation almost goes like that. So you really have to drill down to figure out what it is that's so attractive about this and why people continue to do it. The big one, they finally going around and they said, well, you know, we don't necessarily make more on our loans, but we save more deals from dying. And I think that's a really big deal with this. I call it the pricing and margin flexibility tag. With a broker, particularly with the new compensation rules, you're locked in with a particular compensation plan. You're going to make 2.5 points with this particular investor. And then all of a sudden your homeowner gets a call from one of the big national call centers and he says, can you match it? This guy's offering me an eighth better in price or an eighth better in rate, let's say. Can you match it? And you can't. You have to totally shut down, redisclose, start the whole process over again. Or you can just shave your margin and cut an eighth off of the rate. You know, relock the loan with your investor, take the 0.5 point hit or whatever it's going to be, and get the loan done. Okay, now you made less. True, but it's better making zero. And sometimes you run into those situations. Or maybe you screw up. Maybe there's a delay that was your fault, and you want to waive a processing fee or something. You can do that as a lender without any kind of. You have to be careful about that. You have to document why you did it. It would be smart to do that from the fair lending standpoint. But generally, you can make adjustments to your pricing to help a deal make more sense. In the government world, if you're doing VA loans, for example, there's oftentimes pricing if the rate's in 0.5 point increments where you're leaving money on the table because you can't make that extra premium because it's above what your comp plan is. Well, you can now. As a lender, you're just going to make whatever the margin the investor pays you is. As a mortgage lender, I felt like you have a better image in front of your consumer. I swear to you, and my clients will deny this when I press them on it, but when they're sitting across the table from their consumer, if they're actually meeting them in person, you're looking at this consumer and say, I like you. I think you've got a good job. You have excellent credit, stable income. I think you're fantastic. So let me introduce you to a guy who's going to make you a loan. I mean, that's what you are as a mortgage broker. Let me introduce you to a guy that's going to make you a loan. Or you look across the desk at this consumer and say, this is a great loan. I'm going to make it. I'm going to make this loan. And I'm literally going to take personal risk. I'm going to risk my business, my family, my assets to make you this loan. I swear to you, carry yourself differently in that conversation. You may not think you do, but you may think you're a smooth professional. I'm sorry, when you know you're taking risk on that consumer, they can feel it on the other end of that phone line or across the desk from you. They feel that you're involved in this transaction with them. And I think they walk away a little more impressed with you. Like I said, everybody denies this, but I really think there's something to that. And I think that's part of the allure of doing this. Recruiting tool, of course, you're trying to hire a loan officer who works for a bank. God forbid you take one of my bank loan officers, but maybe you will. You and be able to offer that the ability to continue to operate as a lender. I think that opens up the population of potential loan officers that you can recruit by being able to offer this warehouse line tool. Garrett already mentioned point 4, the AMC flexibility. I have some clients, that's why they got the warehouse line originally. Their favorite investor has a crappy AMC in whatever market they're in, and they want to switch and they cannot, but they get the warehouse line, then they can use the AMC they feel is more reliable for their particular market. You know, the investors negotiate these things frequently nationally. So an AMC that's really great in the upper Midwest may be terrible in Colorado, and they can't help that, but you can if you're a lender. And then just the general settlement experience. You're more engaged in the closing. You're not referring the loan over and sitting around and waiting to hear when it's closing or waiting for your broker for you to come back from title. You're engaged. You know when the docs are going out. You know when the wire is going out. The warehouse system's going to give you a notification with a Fed reference number. Your sleeves are up and you're involved in the settlement experience. And the best lenders of all, the ones that attend their own closings, I always advocate for that. If you're able to, you should sit there in that title company with your borrower and watch it fund. But they'll know you're the one making it happen. And I think that control piece becomes more and more important the more sophisticated your mortgage company gets. Other benefits of being a lender that I want to talk about. One is TRID. I really hated TRID when it first came out. It caused a lot of problems for a lot of people. There were a lot of loans that got stuck due to stupid little errors on documents, etc. But the biggest impact of TRID to me has to do with issuing the LE at the initial application phase. Because if you're a broker, the investor has to issue those disclosures. What that's saying is that you have to pick your investor before you know anything about your borrower. And I've met mortgage brokers. I've gone to the national events where the broker puts their hand on their heart and says, I'm a mortgage broker for life. I don't trust lenders. I'm a broker. And because I believe it's my mission to match my borrower to the best investor program out there in the business. And I think that's great. I think that's a very laudable goal, except that you can't do it with TRID. You have to pick the investor before you even got to know this borrower, looked at his credit, checked out his appraisal. You're smart enough to know which investors are good at certain types of loans or certain types of situations of employment, but you've already chosen the investor before you learned all that information. So as a lender, you can issue your own disclosure. You can still have the investor. Some investors will issue disclosures for you, but some don't. And that's fine. You can issue your own disclosure. It's not that hard. But the beauty of it is, say you sell to 5 different investors, you can have one standard disclosure for all your loans, same fees, same process, et cetera, et cetera. So you issue your borrower a standardized disclosure at application. Then you get the documents in, then you start looking at them, and then you start finding out which investor they match with. So I almost feel like becoming a lender helps you fulfill the traditional broker mission. And I think that's a great benefit morally of being a lender versus being a broker. I talked about simplifying disclosures. I talked to a guy who has a call center. He does a lot of loans per day. He's a big lender, and he went from broker to banker a couple of years ago. He came back and reported to us that without having to disclose the weird ass debit and credit of premiums, it takes 10 minutes off of our application time. He was doing it at a volume where that 10 minutes mattered. It simplifies the disclosure process when you're looking to go, here I am, here's the lender, here's the fees you pay to me. There's no games with, here's a lender credit that's getting reversed here, and here's where you get a credit to get your closing costs. All that goes away. You're very flat. Here's the fees, here's what I'm earning. Makes it easier for the consumer to understand the disclosure, not feel like he's getting double talk from you, and it saves time in the conversation. That leads to point 3 here, where you pick up some credibility. The consumer feels like you know what you're talking about. There's no, you're not having to explain things to them. I always say, if you get to the point where you're explaining, you're probably losing. So, things are up front and forward, which helps. There are real estate agents, there are home builders, other referral sources who insist on working with lenders due to maybe an experience they have with the broker back in the day. That population exists. You all know they exist. Being a lender, open those people up to you that you might be close to at this time. All right, I'm going to move on to what warehouse lending costs. And I do say we have the ability for you guys to raise your hand and ask a question. I do not mind getting interrupted. Talking to me is like drinking from a fire hose sometimes, and I don't mind if Steven jumps in or someone else with a question or if I didn't hit a point hard enough. And that goes for you too, Garrett. If you want to amplify any of my points, this is not the David Frase show, I hope. In any case, moving on. There's
David,
Steven.
thank you for reminding everyone. Yes, I want to remind you, you can submit questions through the Q&A panel at the top or even use the chat, and we'd like to cover those during the webinar.
Right. It's also possible that everybody's fallen asleep, Steven, because it is early in the morning and everybody's freezing to death in Dallas, or up in North Texas. So who knows? All right. So what does it cost? What am I paying for here? The first thing that a lot of people don't necessarily get right up front is you have a commercial loan with the bank. You have a warehouse line. It's a commercial loan from the bank. The bank has made you a loan. The bank is charging you interest on that loan every day you use that loan. So you have interest expense. Whatever rate the bank charges you is a rate that you've got to pay every day that loan is outstanding. But the other thing that a lot of people forget is that you're also the lender. You've made a loan to a homeowner, okay? He's paying you interest at the same time you're paying the bank interest. So interest is really not a very big deal on a warehouse line because usually they're pretty close to each other in income and expense. Not uncommon for larger facilities where you can actually earn more on the mortgage than you pay to the warehouse bank. I hear in the industry starter lines roughly are pricing around an index called SOFR, which is running roughly 4.3% right now for the 30-day SOFR. It's a new index like LIBOR used to be. SOFR plus 2.5 seems to be around the range of where most warehouse lenders are pricing right now, which would translate to a rate of roughly 6.8%. Changes whenever the Fed changes policy. Okay, so mortgage note rate is also right around 6.8%. So you're earning and paying at the same rate. So your interest is washing. Okay, now you might end up paying a little bit more, but even if you have like a negative spread of like 0.5%, that's $4 or $5 a day on a $300,000 loan. It's not a big amount of money. And when the loan's only turning in like 6 days, you're talking about an interest expense of maybe $25, $30 per loan. That would be almost a worst case scenario there. The introductory lines fees, I get dangerous quoting these out loud, but fees of around 100 to 150. Sometimes you get a little bit better than that. I have this funny argument with a lot of clients where they just go off of the fee and don't pay attention to the spread. So I'll have them banking with a bank that's charging them a huge negative spread where it's costing them $9 or $10 a day, but their fee is $25 less than mine, and so they're going with that other bank. I said, look, do all of the math, not just part of the math. You're losing. You're going with that guy because he has a $25 fee, but you're paying him an extra $50 in interest. And we are actually a better execution if you do the math. And a lot of people don't sit down with a calculator and look at what's happening. And I think if you're going to be a financial institution, you really need to be good at math, and you should do the math in your business in every aspect. Somewhere else, banks, instead of charging a SOFR type rate, they might just use the actual note rate. They might say our price is note rate plus a quarter, or note rate minus a quarter, or note rate flat. And that's easier to understand for you. It's tougher for the bank because the yield curve can really impact them negatively at certain times, like last year. But note rate is definitely a very popular index in the warehouse world. But you also have to pay attention to your agreement. The warehouse lender may have floors on the rate. He may have a separate shipping fee that's not part of his transaction fee. He may have a renewal fee. He may have a non-refundable application fee. And it's even possible you might run into what's called a non-use fee, where if you have a zero balance on your line, they still charge you. You don't see as much of that these days. It's been a pretty competitive market, but these little wrinkles in pricing come and go with the market. And you should be reading all of your agreement, make sure you understand all the terms of your warehouse agreement before you start engaging with it. And when you're shopping, you need to know all the aspects, not just what's your rate, and then call the next guy and ask him what's his rate, because what's your rate is a long conversation with a warehouse bank. So it's important to understand what you're talking about.
Hey,
David and Garrett.
All right.
Go ahead, Garrett.
I was saying, I wanted to tell you a little story. A good friend that I got started as an emerging mortgage banker back at Flagstar. We were getting together talking about profitability, and he was talking about how much it was costing him a loan. He said, "Well, let me see what your warehouse loan agreement looks like." And I read through it, and it was costing him $500 more per loan doing business with the warehouse bank he was doing business with than taking him to a competitor or offering him a choice of competitors. And he still claims he owes me dinner, haven't gotten it, but. But it's really interesting that it's so critical. I'm old school, which means I'm old. And when I go in and I'm talking to a new potential candidate, one of the questions that I ask in my interview process is, who do you warehouse with? Why? Do you know what your terms are? You'd be amazed the number of them that when you ask what their terms are, they go, huh?
They don't know.
They really don't know. And it can be a very, very expensive component if it's not executed properly. There's a lot of fantastic partners in the warehouse business. I am not trying to throw anybody under the bus. I just want to reiterate what my friend David said. Please look at the terms of your agreement carefully and understand what you're getting into. So that's it.
I'd take it a step further. I wouldn't just look at the terms. After you have activity, look at the actual activity and make sure you're being charged what you think you're being charged.
Yeah. Yes, sir.
And heck, I can make mistakes. I can fat finger a rate in my system and I'm charging the guy a half point more than I'm supposed to be charging him based on the agreement I gave him. I'll make a mistake. The only way it's going to get caught is if you pay attention. And we try to audit our work, et cetera, but mistakes happen. If you're not actually looking at your transactions and balancing them out, I think you're missing something here. Now, I'll also say that I feel honor bound to say that there is more to the warehouse relationship than cost. Cost is a very, very important component, but this is a relationship. We will tell you that over and over again, because when times get tough, the relationship is a very, very big deal. We'll talk a little bit more about that here.
David, we have a couple of questions.
Excellent. Let's go.
Both of these from Jim Harrison. The first question is, many brokers ask, what is the minimum amount of loans to have a month to become a lender? Is there a magic number?
No, there really isn't. I think you need to use a line so we don't have to retrain you every time you have a transaction. I have dozens of clients do 2 or 3 deals a month. I love them. I don't make a lot of money on them, but there's a lot of them. And the concept is, once you stay engaged with us, your company I've had companies have gone from 3 files a month to 100 files a month. Just they have a little good luck down the road. They pick up another branch. They pick up some people. I don't mind working with these small guys because you never know which one's going to become a big guy. I got people who are nearing retirement. It's a husband and wife team, and that's just all they do. But they're really reliable people. They're very careful with their business. I consider very low risk. And we're happy to work with them, and other banks too. I'm not the only one like that. It's diversifying our risk amongst a number of lenders. Like, if I had 5 companies, each of them who did 100 deals a month, every time one of them calls me and says, "Hey, I just got a better warehouse rate down the street," I'm thinking of walking. Well, I got to do something because that's 20% of my business. All right. Well, with the little guys, it's not quite so price competitive for me. I can run the program the way I feel like I should and not cut my terms or cut my risk processes to save one deal. But on the same side of it, these small companies tend to be very loyal because they appreciate the bank paying attention to them, providing them advice, introducing them to vendors, et cetera, et cetera. There's a lot more to that than that. And frankly, I just really enjoy working with these smaller people. There's no guile about them. They kind of tell you what they're thinking. Their hearts are on their sleeves, and you know where you stand with them. And I really kind of find that refreshing.
That's good. Thank you. And then the other question, what can a broker expect from a warehouse lender in regard to initial credit process and ongoing monitoring, such as financial reporting?
Absolutely. That's coming. There's a slide, I swear.
Gotcha.
You stand by and don't hang up on me. You'll know everything. So that's coming.
Sounds good. Thank you.
Hello, Jim. Jim Harrison was at Texas Capital with me back in the beginning, too. I'll give him a shout out for that. All right. So to understand how your bank's going to behave, you really need to understand what his risk is. I think you should pay attention to what he's worried about, the things that scare him, because I think that's very, very important. Warehouse lending is considered very low risk lending, particularly I think what we do here with the non-Dell side. However, there are things that go wrong. And the number one biggest thing of all that we worry about is fraud. I mean, we can accidentally sign up Tony Soprano mortgage, and we're not funding real loans anymore. We're funding fake loans. and we don't find out about it for a few weeks until we've already put several million out. Fraud's a very, very big deal, and warehouse lenders have techniques and processes and red flag systems to spot people that may not be on the up and up. I'll give you one example that I can think of is we have the, I'll try to be nice about this, the a-hole factor. If the client is an a-hole, which we all know, they're out there, everybody's dealt with them. And we have a rule inside our organization that not every a-hole is a crook, but every crook is an a-hole. It's like one of the biggest red flags. If the guy's pushing you constantly giving you, or a woman, giving you a hard time about this term or that, or asking for exceptions over and over again, it may not be that they're just ornery. They may be probing your defenses. They may be looking for an opening that they can exploit, or talking you into doing things you wouldn't normally do just to keep them happy. If somebody pushes a little too hard like that, the red flag goes up, and we start getting much more conservative on how we operate with them. The other thing the warehouse lender worries about is product. I mean, right now I'm seeing some rate sheets from the non-QM world that scare the crap out of me. There's some loans I really don't want to own in my portfolio. If, when worst comes to worst, that's what happens to me. We are very hesitant on certain products, and every warehouse bank will have a bandwidth of things that are acceptable. They may either control it by giving you a sublimit, which means you can only use a portion of your line for this type of product. They may prohibit certain kind of products. They may prohibit certain investors from being able to fund loans. The non-QM world tends to blow up about every 10 or 12 years where none of the loans are sellable all of a sudden. If a mortgage company specializes in just that product, they will probably shut their doors. And that leaves the warehouse lender stuck with the loans. In 2008, in the big mortgage implosion, that's what we lost most of the warehouse lenders in the country all shut their doors during that time frame. And it wasn't, it was just that they had found themselves suddenly holding a bunch of product that was worth 75 cents on the dollar. And the board of directors wasn't aware that risk existed, and so they shut their programs down after that. The ones who stayed alive are the ones who bought flow business and, stayed in between the lines. And there were about 10 or 12 warehouse banks that went through that extremely well without any losses at all. But a huge number of other ones got wiped out just by owning bad products. Volatility is a problem for a warehouse bank. We have a certain amount of cash we deploy, but it slows down in winter and speeds up in summer. Mortgage rates drop 70 basis points, and everybody's calling us for an increase. And a good warehouse bank has got to be flexible to be able to handle the wild swings in the market. And they need to understand that certain times the warehouse bank's going to be chugging along doing very little, and then it's going to be begging for more money. And if the bank doesn't have the capital liquidity to handle that kind of swinging, it'll be a problem for them at some point inevitably, and that will affect their clients. Warehouse lenders worry about counterparties. When a client introduces me to a takeout investor, I don't just put them on my list. We go to the takeout investor and get their financials. We ask them for their financials every quarter. We want to know which investors are having trouble. And we have a minimum net worth or minimum liquidity requirement, and we do monitor them just like we monitor the clients. Because that investor is theoretically, particularly in the non-Dell space, yeah, I'm loaning to you, the mortgage company, but technically I'm lending to the investor. Because if he's not there to pay me off, then I got a problem. So I got to make sure the investor is going to be financially sound, as well as the mortgage company that I'm doing the business with. So we worry about counterparty risk. And then warehouse or liquidity themselves. Banks, we've lost a few warehouse banks here the last couple of years. A lot of cases, it was a very simple trap they got caught in. COVID started. They believed that loan demand was going to evaporate. So they knew they were going to need to keep interest income coming in to keep the shareholders happy. So they went and bought a bunch of securities. They went and bought a bunch of bonds, Fannie Mae securities, treasuries, things like that. And then all of a sudden the economy took off and their loan portfolio started growing instead of shrinking. And they had these securities, but rates went up. So the securities were underwater. And so the banks had to choose. I can sell the security and take a huge loss, or I can, shrink the bank or do something else. And a lot of the banks chose to exit warehousing to free up liquidity they needed for their other projects. And that's a bank that wasn't necessarily committed to the business in the first place. You got to, when you're talking to a bank, find out how long they've been in the business, find out how committed they are, what kind of financial swings have they gone through already, and that'll tell you how tough they are and how committed they are to the line of business. Ask them if they've ever had a loss. A warehouse banker that's had a loss and is still in the business, that's an impressive company, and you need to pay attention to them because they're obviously very committed to this line of business, and it's not just a sidebar for them. when I'm hunting for a job, that's a question I'm going to ask from time to time. Okay, here's what can happen to you. What can go wrong for the mortgage company? The first one is pretty rare, but it exists. It's called the post-closing pre-sale event. Something happens between the day you fund that loan, but before you sell it to the investor. I'm thinking, I don't know, hurricane, fire, borrower dying has happened to me before a couple of times. Um, Divorce, sudden divorce, things like that can suddenly kick up. Unemployment, your borrower could lose their job. The investor might do a verification before they buy the loan. Some investors do not do that. It was a very big scare for us during the COVID, where investors did start doing post-closing employment verifications because homeowners were getting furloughed every other day. I had some very smart clients that went back to brokering during that time frame. I regretted losing them for a little while, but it just got too risky for them, so they went back to brokering until the jobs market calmed down. I get it, and it was not necessarily a bad decision. I regretted losing that business, and everything turned out okay, but that's something that can go wrong. We've had people make a mistake. We'd have a documentation problem on their loan, and they would have to refinance the loan to fix it. But they tore up the kitchen in the process. So we have to wait for the kitchen to get done before they get the loan fixed. Things like that can go wrong. Documentation disclosure, issuing the CD a day late, that's a fatal error. You can't fix that kind of a problem. Some kind of error that the mortgage company caused, a third-party fulfillment company didn't cause, that might cause that loan to get stuck. Usually refinancing the loan is the fix, but God forbid you make a mistake on a Texas A10 loan because you got to wait a year before you can refinance it. So that's something that can go wrong. Again, counterparties, your investor can go out of business, your warehouse bank can go out of business. Another thing a mortgage company should watch for is just availability on the line. How much line have you got? It's a good problem to have, but it's a scary problem to have if all of a sudden you've got 5 deals closing next week and you only have $500,000 available on your warehouse line. How fast can that warehouse lender respond and get you an increase? Do you deserve an increase? Is your line maxed out because you have a lot of aged loans? You may not be able to get that increase, and you may have people go to closing where you don't have money to fund the loan. And that is a very scary problem. And we do encourage you to get enough line to cover those kinds of contingencies. But a lot of times we'll talk about what it takes to qualify for that. You want to make sure you kind of obtain approval for more line than you need is always a good plan, I think. Here's things you can do to avoid the risks that are inherent. Number one, non-delegate underwriting. I think that's one of the smartest things you can do, particularly if you're new to this. Have the investor underwrite the file, okay? An underwriting error on your own can really cost you a lot of money, and that's very, very important. Using a third party to generate your legal documents, these are all things that I'll require for a newbie. Some warehouse banks may not. I'm thinking you should strongly consider that anyway, because it's a great way, particularly when you're getting used to it. Have somebody else do the work, watch them, learn, then maybe take it on yourself later if you really must. But there's some expertise to closing loans that doesn't come naturally if you haven't done it before. Definitely best efforts pricing. Don't be doing mandatories. It's not cool. We won't permit it. We want the loans to be able to get extended. We don't want penalties if the loan doesn't close. If a small company is not ready for that yet, that's down the road. Next, just because you have a warehouse line doesn't mean you're banking everything. You're still going to broker some loans. You'll always broker some loans. I don't care how big you are. When you're starting out, stick with the A-paper loans. Don't try to warehouse your non-QM loans. The rates are really high, and that's kind of exciting. But just until you really have the feel for what you're doing, your bank is comfortable with you, stick with traditional paper when you're starting out. Make sure you know who you're hiring in your company. That's number 5. Background checks are really important because you're exposed not just to what you do, but to what your employees do. And you bring in a bad guy, they might really hurt you in a number of different ways. So check them out, check the reference, etc. I'm going to go real quickly through insurance. Every warehouse bank requires insurance coverage. So everybody goes out and buys insurance because they're told to. The investors also require insurance. The most common is called fidelity bond insurance, which is insurance from wrongdoing. And usually the magic number for whatever reason has always been 300,000. I don't know why. Mortgage loans are much bigger now, but 300,000 is always just kind of stuck because it was the Fannie Freddie requirement for many, many years. Buy enough insurance that you feel like you're protected. The fidelity bond is very, very important insurance. What it is insurance against wrongdoing by your employee. And I've had this conversation with one of my little clients who was a one-man operation. He said, "Why am I buying insurance for wrongdoing with my employee when I have no employees? That's ridiculous. Why would I buy this?" And I said, "Well, because that's not where your greatest risk is. Your greatest risk is the title company. All right. You have the warehouse bank wiring your money to a title company to settle your loan. What if that title company runs off with the money? Happens every year somewhere. We hear about this happening. You have two sources of repayment in that scenario. One, you have a closing protection letter, which is a letter the title insurer and guarantees the agent's going to handle the funds appropriately. That's very good, but it only works if the loan closes. Okay. The second one is during that transaction, that title agent is your employee as a contractor. So Fidelity Bond covers you for what the title agent does. So even if you're a single man operation, you get this Fidelity Bond and the title company goes Dixie on you, you have some recovery there. So that's one thing. The other type of insurance we have is what's called mortgagees interest insurance, which protects collateral from a clerical error. It's much more rare type of loss. That's why it's relatively inexpensive. For example, Fidelity bonds probably for a small mortgage company is probably going to be about $1,800 a year. Mortgagees interest E&O is probably $500 a year, something like that. You can get them combined. It's called a blanket bond, and that's usually the way most people do it. Mortgagees interest E&O is if you forget to bind hazard insurance, the house catches on fire, and you've got a loss of collateral, and the insurance is there to protect you from that kind of a loss. It's a clerical error that led to a loss in the value of your collateral. That's probably the most common use of that. And I don't know anybody that's ever filed a claim on that. Have had to. It's so rare, but it's required, so you have to get it. We'll also see professional liability required by some banks, which is basically lawsuit insurance. And to me, that's kind of a red flag because if your bank wants you to have lawsuit insurance, guess who's thinking of suing you? That bank. So that's usually pretty expensive. That's the professional liability, usually $4,000 or $5,000. But some programs do require that, and that's fine, but it's a little bit more pricey insurance. The other thing you can do to mitigate your risk is just talk to your warehouse bank. We don't want to put people out of business. We're not interested in knocking your front door and making you buy a loan back and stealing your kid's swing set or whatever else. That's not how we stay in business on the long haul. If you got a problem with a loan, your warehouse bank's your first phone call because you're in a new world for yourself, whereas they're veterans at dealing with broken loans. There are people out there that will buy broken loans for a percentage of the face amount of the note. There's a lot of different ways out of a loan that you may not have thought of. The warehouse bank has seen done. So, but some people are afraid to call their bank because they think they're going to get in trouble because they made a mistake. And my God, mistakes happen. We're the best ally you've got. And on top of that, you call me when you have a problem. I know, hey, I can trust this guy. He called me when he had a problem. He didn't hide from me. I feel much better about this client than I did before he made a mistake. You can actually score points that way when you make a mistake. They'll be your best friend working through a problem, but when you start lying to them or evading them, they will be your most dangerous enemy. So what's hard about running a warehouse line? I think everybody says funding the loan is way easier than they expected. You get the loan, you fund it, that's great, but it's actually much easier than you think. The hardest part is financial reporting. You've got to produce, the mortgage company is going to want you to produce financial statements every quarter that show income, expense, balance sheet, et cetera, et cetera. If you're not comfortable with that, you're going to need to get a CPA or someone help you. You don't necessarily have to have audited financial statements, but you definitely need to know how to spread your company on a moment's notice and explain why you're making money, why you're losing money, how much money you have, where you have it stowed. All that's very important. If you're operating in multi-states, understand that a lot of states have different licensing for lenders than for brokers. Texas is not like that. Texas is pretty simple, one of the simpler states in the union, frankly. But the other states that have other requirements to be a lender, some require audit statements, some might require a minimum net worth. Make sure you understand licensing before you start operating outside the state you're normally in. Watch for regulatory changes, interpretations, things like that. Another thing I'd say is your compensation plan. You need to evaluate that very carefully to make sure it's compliant. When you're a broker, it's easy to be compliant because there's a fixed payment process already installed. But because you're making variable amounts on each loan that you fund on the warehouse side, you need to make sure your loan officer is still compensated correctly per the rules of loan officer compensation. All right, how are we doing on slides? We're getting pretty good. We're kind of on time, more or less. How to get qualified for a warehouse line. cash, 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 cash. We like liquidity. We like liquidity more than anything else. And we have a slogan that, cash buys loans back, motorcycles don't. So a lot of people will put stuff on their balance sheet as assets and they'll show great net worth, but they actually don't have any cash. And cash is really the only thing that matters to us, or the way I look at banks. Other banks will focus on net worth, but they're usually used to working with a, more well-established mortgage company. When you're in the broker to banker world, step one, your accountant says don't put money in your company because it's exposed. You want to keep your money out of your company to limit your risk. We're going to tell you the opposite. Okay. You need to put cash at risk in your company, maintain it, grow it over time, demonstrate quarter to quarter to quarter your cash continues to grow. That's what warehouse banks want to see. The size line you can get from a warehouse bank is going to be a multiple of your cash or liquidity. And I'll give you an example. My own program will fund 20 times cash. So if you have 100,000 cash in the company, that's a $2 million warehouse line. And we won't go over that ever. We're very religious about that. Sometimes we'll count some of your personal cash as well as what's in the business, but mostly we want to see it in the business. Understand that you'll be asked to sign a personal guarantee. Very few warehouse banks don't require a personal guarantee, particularly in the non-dollar world. When you start borrowing 150 million from a super Wall Street type firm, you may not have to sign a PG there. But when you're starting out, when you're a smaller mortgage company, yeah, you're going to sign a personal guarantee. You're going to stand behind your work. And I had a client complain to me, I don't want to sign a personal guarantee. I said, okay, so you're telling me that you want me to stand behind your company, but you won't? No, that's not going to work. PG is very important. It keeps the originator focused on who he's hiring, what kind of decisions he's making. Pursuing a personal guarantee for the bank is very hard to do. It's not easy for us to go after it, but we want that behavior controller in place. And as a result of asking for a personal guarantee, we're going to ask for your personal financial position. Biggest mistake clients make with me over and over and over again is they don't disclose all their personal assets to me. They think they're hiding them from me by not telling me about them, but we can tell. There's other ways we can figure things out. We're going to look at your tax returns, personal. We're going to look at your business tax returns. We're going to want to know about all your bank accounts. We may want to see your bank statements to show what your financial position is. And there's two reasons for that. One, we want to backstop the personal guarantee with some analysis. But more importantly, at least to us, is we want to prove that you're in a business where you're successful. We want to know that you can get in this mortgage business, operate, and make money successfully. That tells me that you know what you're doing. So if you're losing money hand over fist because you're not making good decisions, I really don't want to work with you. And your personal financial position is going to tell me whether you're good at this or not. So a smart company coming in will be proud of his personal financial statement. He'll brag to me about his wealth and show it to me. And that's going to work well with us. We also want you to have experience, at least a couple of years of absolute origination experience. Show me that you know how to get a loan approved with an investor without pissing everybody off. Show me that you know how to, the basics of the mortgage business. We'll teach you the stuff about the closed loan side, but just show me that you know how to operate this business with the disclosure rules, documents, relationships, working with borrowers. We want to know that you can do that. We'll ask other people about you. We know enough people in the business. We can find out about you without you giving me any names. We'll find out. We know people who know you, and we'll probably talk to them. We may come visit you. We may come to your office and sit down with you for a while and really talk through this process. Look you in the eye. That's a big deal to a lot of warehouse banks, the site visit. We may come back every year and have another visit. And also, you'll need to show us that you have your proper state licensing, like I said before. How to be successful as a warehouse lender. Communication. Number two, more communication. Keep us aware of what you're doing, what you're thinking. If you're talking about an unusual deal, give us a call. Ask us how that's working. Take care of yourself. Run your own reports. Understand how your business is operating. When you're closing loans, be prepared to say no. If the loan's not fully cooked yet, don't close it. Understanding how you pay your loan officer, because you don't get paid until the loan sells. That's 6 days later. If your loan officer is used to being paid the day of closing, you can keep doing that, but that's going to drain your cash. That may not be the best decision. You may put them on a delayed payroll plan so that they generally get paid until the loan sells. That's very important because sometimes you need a document signed by the homeowner, and if your loan officer has been paid, he's not likely to hop in a car at night and go get that document signed. But he hasn't been paid, he'll go help you there. I'm mentioning it here. I'm not going to talk a lot about it, but you'll need to get signed up with MERS. You'll need to get set up with UCDP and UCD through the agencies. I mentioned HMDA here, but don't worry about that. If you're not under any, you don't have to report HMDA. And then just monitor your agreement covenants. We were asked about quarterly financials, et cetera. You'll get a covenant from me saying you must have at least 100,000 net worth at all times. So every quarter, we're going to want to see financial statements that say you've got 100,000 net worth. And then you'll go through an annual renewal from the following year. We're going to look at your personals all over again. We'll keep doing that every single year. And that's how we monitor what we're doing, so we can tell our bosses that we've got our eye on the ball. Down the road, I'm not just going to list these. I know we're running out of time here, but once you have a warehouse line, your next step down the road, you can brag to everybody about it. You can continue to grow liquidity in the mortgage company. At some level down the road, you might want to bring document preparation in-house. That gives you a lot more control over the process. You may want to obtain audited financials, generate $1 million in net worth, and get FHA approval. That's a big one. Once you can fund FHA loans on your warehouse line, you can really make more money. After that, if you're ready, hire an underwriter, become delegated, then down the road, Big Rock Candy Mountain, you're hedging your pipeline, you're selling to the agencies, accumulating service rights, and you're now the next Angelo Mazzillo at Countrywide. So I went all the way to the end there, Stephen. How'd I do?
You did excellent. I appreciate it, David and Garrett. And before we wrap up, do you all have any final thoughts or key takeaways that you'd like to share with our audience?
Go, Garrett.
I would say that the most passionate part of my job, tell a quick story, got a call from a guy that was a really experienced broker specializing in VA loans. He said, Patrick, and we're talking, and he said, I'm just frustrated with the business, Garrett. I'm thinking about getting out. And I said, why is that? He goes, well, the passion that I enjoy most, VA loans, I'm not making any money at. And I'm not going to get into a long dissertation, but it has to do with what David was talking about, the way you have to price VA loans around compensation rules. And so we chatted. He remains a good candidate. In fact, I talked to David about it. David's going to be talking to him. But there's a lot of people that this model makes sense for. And it's, as David emphasized, it's not necessarily about the dollar and cents. Are you going to get a better execution on every loan? David didn't emphasize this, but you have the ability as a lender to, if you want to disclose a loan with no lender fees whatsoever, you can put no lender fees on your LE. Now you'll pay for them out of the out of the proceeds of the sale of your loan, but you get borrowers that are picky about that stuff, right? So there's just so many tools at your disposal that this offers you. So I too am available anytime. You probably telling my boys, I still get excited. It's what rings my bell, and I'm so glad that you guys gave me the opportunity to be part of this.
Great. Well, thank you, David and Garrett, for sharing your expertise and insights with us today. We truly appreciate the time and value knowledge you've provided. And a big thank you to you all for joining us. We hope this session is giving you a deeper understanding of the transition from broker to banker and actionable takeaways to apply to your business. The Texas Mortgage Bankers Association remains committed to providing high-quality education content through webinars like this one. Please be sure to visit texasmba.org to explore upcoming webinars, access recordings of past sessions, and stay informed on industry trends. Thanks again for being with us today. That concludes our session. Have a great day.
Bye.